Hello, everybody. Hope you had a good week. Ready for the weekend? So, I'm thinking the market's going to go lower, and I will tell you why. Now, here at the Stock Market Jobber, we pay attention to levels, trends, momentum, and psychology. So, I don't know where I should begin, but I guess I'll beginning with psychology. And again, I'm not a genius, I'm not a psychic, but I just think the odds are really good that we get some movements lower over the next week in the broader markets. So here's the S&P 500 ETF SPY, pretty much, pretty much a non-day. It's almost like I even have the wrong thing here. It's like, gosh, just hasn't moved. This has to be an error. It says no movement. Well, anyway, we had a little bit of movement today, but it was nothing to write home about. But here's where I am starting to think we're going to go lower. And one is because we have this excessively bullish sentiment. We have a lot of investors who think the market is going to go higher. And maybe they're right, but here's the thing. When you have the vast majority of investors thinking the market's going to go higher, what do? They invest their money. And what happens when they're done with the money that they can invest, when they run out of their investable funds? The market runs out of buyers and it can only go lower. So excessive or extreme bullish sentiment is actually a bad thing for the market. So let's go over, and I hate seeing CNN because they're really just a propaganda, disgraceful, something that poses as a so-called news organization. And frankly, they've really, whatever, they've destroyed themselves. But every now and then I do look at their fear and greed index, and this shows extreme greed. So remember, extreme greed, people are very bearish. People spend their money, they invest their funds, they run out of funds. The only place the market can go is lower. So we've been in extreme greed here for a while. Now, some of the things they look at here are a little bit outdated, and I would revamp this. Actually, maybe that's something we can do for a stock market jobber. If you guys want to do like a communal class where we kind of put together our own momentum indicator. Actually, I think that would be a pretty good idea. You guys should remind. I'm going to write it down in my notes here. But I should say sentiment indicator. But sentiment's a hard thing to get a hold of because it's nebulous. It's not like something you can quantify. But they look at 7 things. All right, I'll just go through this really quick. If the market gets to an extreme above its moving average, and for some reason they use the 125-day moving average, so that's at an extreme. We got a lot of stocks hitting 52-week highs. So again, remember, markets are going higher. If people get too bullish, market runs out of buyers. Breadth, this is probably a little obsolete. Put calls, this is the lowest level we've been since right in December of 21, which it doesn't show on this chart, but that's right when the market peaked. Sorry about that. You got this extreme level of people are like, oh, things are going up. We're buying options on this. We're buying options on that. And that tends to happen when the mass crowd starts to come in. It's probably time for it to go the other way. Same thing works on the downside. But anyway, so the VIX is very low. The VIX is best thought of as how much the price of insurance costs. It's like how much does it cost to get into an option position, to protect your position, to insure your position. And when the insurance gets very low, it shows people really just aren't very worried. Junk bond demand. All right. So there's that. There's also this, which I look at, which I think is probably a little bit of a better indicator. It's more up to date, but this is the American Association of Individual Investors, and I'm not a member of this, but I'm not endorsing it. I'm not saying you shouldn't be in it. It does seem pretty cool. They got a lot of information on here. But I don't know, whatever. At this point in my life, I'm just not about investing in new websites because I got enough going on. But anyway, it seems like it's cool. And this is free. When we have a lot of in bullish investors, remember, they've spent their funds. The money runs out, or the market runs out of buyers. We got 51% of people or investors or members of their organization are bullish. We've gone from 41 to 51. That's a big move in 1 week. That's a big move, up 10% in 1 week. really bullish. Okay. When we were really bearish last September, that was a good time to buy. As a matter of fact, you know what? Let me just show you that right now. I mean, I don't want to run out of time here because I know it's Friday night and you all want to go do something more exciting than hang out with me, like, hang out with your girlfriend or boyfriend or partner or whatever, but just hang out for a few more minutes and we could look at ways to make some money. So here's the S&P, just a quick flashback, S&P 500. All right, so last time we were extraordinarily bearish, 921.22. So that was right here. And guess what? What happened afterwards? The market rallied. So that's the opposite. You got it's not a huge uh, extreme, but the idea is if people are very bearish, they sell. And when the market runs out of sellers, the only place it can go is higher. So we got this really bullish sentiment, which could be bearish. Now, there's also what could be called a flight to safety going on. A lot of times the smart money, okay, there's smart money and there's not so smart money. The smart money is buying here. The not so smart money is selling there. The smart money is selling here. The not so smart money is buying here. Okay. Um, Sometimes right before markets go down, and I can't quantify this and I haven't seen any studies on it, but just from my experience, sometimes right before we get a big sell off, money goes into these sectors that are considered safe. This is called a flight to safety. Investors take their money out of things that are considered more risky or more prone to having a big downside than something that isn't. In other words, a luxury diamond company. You don't need to buy luxury diamonds. You don't need to, but you buy them when you want to when things are going really good. I'm not saying I do, but now food, medicine, things are things that you need to buy regardless. So we have these stocks that are considered safer. They're in the healthcare industry, the utilities industry, the consumer staples industry. Just for whatever reason, these companies are considered safer. You're always going to need healthcare, but you're not always going to need to go to the casino. So if we look at the healthcare sector, and we're just going to look at some ETFs that track it, look at that. That is a huge move. And we're even up in the aftermarket here. That is a huge, huge, huge move for the healthcare stocks. Money could be coming out of things that the smart money thinks like, oh, time to get out of Tesla, time to get out of or time to get out of Facebook, blah, blah, blah. Let's park our money in something that's safer. This is a huge move for healthcare. It's like a real blowout move. And remember, we talked about levels, trends, and momentum. So we discussed in psychology, we just talked about the psychology with the extreme bullishness that's occurred all of a sudden, probably because people think the Fed is going to stop raising rates, but they're wrong. I think the Fed, if they knew what the F they were doing, we wouldn't be in this mess in the first place, but they should be more aggressive now, like I was saying 18 months ago. But anyway, okay, so we blasted off former resistance level. There's people that bought here that regretted doing so when the price gets lower. So they tell themselves, man, I want to get out, but only if I can break even or get out of break even. So when the price gets back up to their buy price, they try to sell. And if you get enough of these sellers coming in, it creates resistance. So you see a lot of times you see resistance at former peaks, like right down here. All right, so healthcare considered safe, blasting off. Consumer staples considered safe, blasting off. Ascending triangle. These are pretty reliable patterns. You got the group of sellers hanging out, willing to be patient from June to July. They were like, we'll be at 70, 80. If it works out, we'll sell, but if not, we'll miss. But at the same time, you got the buyers getting more aggressive. That's why you got these lower highs. Charts are there to, charts, if viewed correctly, are graphical interpretations or illustrations of psychology. So we have healthcare blasting off, we have consumer staples blasting off, and we also have utilities blasting off. I mean, look at that. That is an incredible move for utilities. We can see here are levels, right? Support. You don't need to be a guru to see this. Some price levels just happen to be more important than others. Here we have the descending triangle. This is the opposite. Buyers are patient down here. Sellers get more aggressive. All right, now let me just go on here really quickly. A couple things to watch in the broad market. The healthcare sector. See, this is why we're really setting up for something, Ivan. We got this extreme bullishness. We got money flowing into the safe sectors. We have our big tech sector here, right back testing this important level. Now, notice 177 was resistance here, and it was resistance here, and resistance converts into support. This is seller's remorse. People sell, and the price goes higher. They regret doing so. So they go to buy their shares back. Seller's remorse. When markets are going higher, we have seller's remorse. Sell goes higher. People say, man, I made a mistake. If I can buy my shares back at the same price I bought them at, I'm going to. You have them placing their buy orders at the level that was resistance. If there's enough, it converts it into support. Resistance becomes support. Resistance becomes support. Resistance becomes support. Now, if resistance does not become support, it tells us that the seller's remorse has kind of left the market. And when you don't have seller's remorse anymore, that's the characteristic of a market top. Now, I don't know what's going to happen. I'm not a psychic. Based on the sentiment numbers we just talked about, my guess is that this breaks. But will this resistance become support? It has for 2 days, but these are huge markets. It's going to take a little bit longer to see if that plays out. The other thing we got to watch here is the financial sector, because this has gotten to resistance and it's testing it, and it's overbought. Remember, levels, trends, momentum. Okay, we talked about psychology. Levels, trends, momentum, psychology. We got the two most important sectors in the market right now, financials and tech, both at important levels. One's testing what could be support, one's testing what could be resistance, and it's overbought. Overbought means something is trading at an extreme above what would be its typical or usual range. That's going to draw sellers into the market. Resistance is a large group of investors trying to sell at or close to the same price. So you get this double whammy. You get to a level where you got a lot of sellers and you also get overbought, and that's going to draw a different type of seller and sellers with different strategies. So there's our momentum. All right, so my guess is the market goes lower. We're going to get our signal right here from financials and from tech. You don't jump in now. You don't do anything now. You wait to see which way the market breaks. Could go a little higher, but I'd pause to go lower. But we could go a little higher before we get through this reversal, which I expect is coming. Now, before I go, I just want you to remember, if you're not an options trader and if you don't short, there are ETFs that you can buy that will go up if the market goes down. You can always make money in any market. All right. You don't need to put your head in the sand. And frankly, it's a lot easier to make money in markets that are going down than up, because markets go down faster than they go up. So this is an ETF that goes inverse to the S&P 500. If you're really bearish and you don't buy options or short things, this ETF is designed to go 3 times in the opposite direction of the S&P. So if the S&P goes down 5%, this thing's going to be up 15%. All right, everybody. I hope you have a nice weekend. Make sure you check back. I got a lot more stuff coming. There's a lot to talk about in the market, and I will see you then.